accelerators as the guest of Swiss EP program. And I've come back now for 2 weeks. I'm the president of Valhalla Private Capital. It's an organization out of Canada. And just to tell you a little bit about Valhalla, looks like it's a little bit out of order. What I've been asked to talk about today is angel investing. Angel investing is a critical piece of the startup ecosystem. Without investors who are willing to invest in the earliest stages of a startup, it's going to be very difficult to establish a vibrant ecosystem. And so I've been asked to talk a little bit about angel investing. And what I'm going to do is talk about how startups are different. I'm going to talk about how angel investors view startups. And hopefully what I have to say will resonate with those of you who are considering becoming investors in startups, and with those of you who are founders of startups and are seeking to raise capital. So I'm also going to talk a little bit about how angel investors view startups from a valuation perspective. And lastly, I'm going to talk about what really drives angel investors in investing in startup businesses. And I was going to talk about pitching just a little bit, but we're not going to have time to do that. So let me just tell you just very briefly about myself. I'm the president of Valhalla Private Capital. We have an angel network in Canada with 130 members. It operates in 4 branches or 4 cities across Western Canada. We've invested $44 million in over 151 startups. Now, just for those of you who don't know about angel investing, angel investors are individuals who invest their own money in startup businesses, as opposed to venture capital firms who invest money that's raised from other institutional investors. And so we represent 130 people, individuals, who have decided that they want to invest a portion of their savings in innovative startup businesses. And then my organization, Valhalla, also has a number of other arms, including some investment funds that we manage in Canada. And so I've been back here this week talking to local partners that I met when I was here a number of months ago, and we are just looking at doing our first investment in a startup in Ho Chi Minh City. Just briefly about me, I was a lawyer, mergers and acquisitions lawyer for about 30 years. And this is a picture of me last month at the American Angel Capital Association Northwest meeting, where the wings representing the host of the meeting were turned over to Valhalla because we are hosting the Angel Capital Association in Calgary next year. This is just some pictures of various events and competitions that we've participated in for startups. The one on the lower right-hand side is a boot camp that we did participated in Ho Chi Minh City in March. So, startups are different. As I said, angel investors are individuals who want to invest in early-stage businesses. And a lot of them are business people or professionals who have made their money doing their work for a number of years and now want to start investing in startups, but they find startups very, very confusing. And so one of the things that we do in Valhalla is help those people understand how startups are different from traditional businesses. So the first question is, what is a startup? And I'd like to just distinguish it from 2 things. It's not a lifestyle business, which I'll talk about in a minute, and a startup is also not a large company. So it's something in between those 2 things. And Paul Graham, who was the founder of Y Combinator, an accelerator in the US, made the point that startups and large companies are very different. They both have their own challenges, but they don't function in the same way. So what's a lifestyle business? Usually it's individually owned. It focuses on the local city or a region. There's very efficient business operations, very excellent execution quite often, but not too much innovation. The business model is scalable, is not scalable, and it has steady linear growth. And that can make a really good business. But typically that's not the kind of business that will be of interest to risk capital investors, and that would be angel investors or venture capital investors. The kind of business that's of interest to angel investors or risk capital investors, we call startups. They are businesses where the founder wants to change the world. They found something that's really innovative, and they have an ambition to become global businesses and bring that innovation to market. Startup businesses have the potential to grow really quickly and to provide the kind of growth returns that can pay a decent return to a risk investor, to an angel or a venture capital firm. And I've given some examples here of differences between lifestyle businesses and startup businesses. And just to make the point clear, lifestyle business can be a really, really good business. It just would be not an appropriate business for a risk capital investor. So what is a startup? Contrary to what most of you probably think, a startup itself isn't a business, it's an experiment. It's searching for a viable business model. So what do we know about startups? We know that they develop in 4 stages. Discovery of an idea or a prototype, validation of that idea or prototype with customers, gaining efficiencies in the business, refining the business model, and then scaling the business. And in a survey of over 4,500 startups in the US, it was shown pretty clearly that startups that skip those stages perform worse. In fact, some of them fail because they haven't progressed sequentially through the stages. It's not a life or death situation, but their survival is dependent on finding a meaningful solution, a real solution to a meaningful problem. And that's one of the most important things that determines whether or not a startup is going to be successful. And that's what angel investors are looking for. In the efficiency stage, the startup is looking to refine the business model, to refine the sales process, to make sure the right team is in place, to start hiring managers. And in the scaling space, it's efficient use of capital to really grow the business. So if the startup doesn't get product market fit, it's going to fail. If the startup doesn't find the repeatable sales model, it may still survive, it may become a lifestyle business, it may become successful, but it's going to take longer and the use of capital won't be efficient. So we also know that management teams are the key criteria by which startups navigate those stages. The management team is really, really important. And we know that traditional management methods don't apply to startups. Startups are governed by what we call chaos management. So quite often when we have new angel investors that come into our group, and they come from big business, traditional business, and they find startups to be really, really messy and confusing and not clean. And that's true. That's how startups develop. Jessica Livingston, another co-founder of Y Combinator, famously said this a number of years ago, that startups are very, very messy, and they are. A lot of traditional business people run from startups because of that. And one of the reasons is because startup founders have to develop everything from scratch. They don't have a team. They don't have a company in existence. They don't have financial statements. They probably don't even have advisors. They don't have customers. They don't yet have a product. And they for sure don't have a business model. So all of those things, they're starting from scratch. And sequencing the piece of growth of all of those things across these stages of development is a very big challenge for startup founders. We also know that a couple of things come out of that. The sequencing is the biggest challenge, and for those of you in the room who are founders, you know that it's a big challenge to decide when to bring on your director of sales, or when do you hire your first team member, or if you're a team of developers, when do you bring on somebody who's got business background. Those are all significant challenges for a startup founder. The development of a startup is never linear. It's always very bumpy. And the bumpiness is a real emotional roller coaster for startup founders. And that's something that angel investors need to be aware of and need to manage. And that's also true of mentors. So if you look at this graph, this is a very well-known chart of the bumpiness of the development of a startup. And a startup can get a lot of traction in the very early days, but it turns out that that's not really evidence of product market fit. And the emotional turmoil of going through the up and down of startup success is very challenging. So the startup founder might go through the initial phase where they get some early sales from friends and family or from early adopters of the technology, and they think that they're going to shoot the lights out. And then when that falls off, they find it very hard to cope with the fact that maybe they're not going to be successful. And if they're lucky enough to find product market fit and to grow the business to be very successful, then they forget all of the things that happened before, and it becomes a story that they knew they were going to be successful all along. So how does a startup experiment grow into a successful business? Well, this is the search for product market fit. And until the startup finds product market fit, it finds a customer who's willing to buy its product, needs to have the product, and there's lots of customers who will buy the product again and again. Until the startup achieves that, there is no business. Once it achieves that, it can focus on the business fundamentals and creating the company. And if it's able to navigate that, it may even be able to scale the business. If it isn't able to navigate the efficiency stage, then it may become a lifestyle business, and that's a problem for angel investors. So the objective of the founder is just to stay alive, and on this point, the angel investor and the founder's interests are aligned. So I just want to talk a little bit about mysterious, that startups are mysterious. There's a link between how startups develop and how valuations are determined for startups. So normal companies are valued using financial tools like a discounted cash flow, or to look at comparable businesses and how their price trades on the stock exchange or in the marketplace, or to value the assets of the business. But none of those things apply to startups. They don't have cash flow usually, they don't have any revenue. Up until recently, it was very hard to compare other businesses, and they generally don't have any assets. So valuing a startup is a very big challenge for investors, and it's what most new angel investors find really frightening. So if we know traditional management methods don't apply to startups, we also know that traditional valuation methods don't apply to startups. So understanding startup valuation is very much linked to understanding how startups grow, the process that I just described. And this is the early stage financing chart. I'm sure most of you in the room who are founders or investors are very familiar with this. And the only thing I wanted to point out here is the importance of having enough cash to get through the valley of death, and I'm going to talk about that. So this is a typical staged financing for a startup. This is very standard in North America for the kind of capital that a startup is going to have to raise. So in North America, your average startup would raise 6 rounds of capital and would be diluted. The owner would be diluted around 20% each round, 15 to 20%. The red line I've drawn through that chart is the growth curve of a standard startup that shows the significant returns that would be of interest to angel investors. And when that line starts to rise, usually around the 3rd round of capital after the angel round, is typically evidence of the startup having found product market fit. The research from 4,500 startups in the US has shown that it takes an average of 3.5 years and $5 million of capital for a startup to grow to that point. But the most important thing for angel investors is to know that it takes an average of 2 years and $1 million for the startup to get to product market fit. And that's an average. So some startups may take a little less, but lots of startups will take a little longer. So that's 3 years of experimenting to get to product market fit. And that's the critical valuation information for angel investors. So the message I've tried to leave is that a solid team and finding product market fit are the 2 most important factors, both for startup founders and for angel investors. But a good team without product market fit simply can't be successful. Founders overestimate the value of their intellectual property by significant amounts, and that impacts the negotiations between angel investors and founders. And startups generally need 2 to 3 times as long to validate, to get to product market fit than founders estimate. So I'm going to, the last point I want to make on this is that the research has shown that learning significantly improves outcomes for founders. And this is the kind of work that incubators like DNES do with startups. Of all the startups that were surveyed, it was determined that startups that had good mentors, that paid attention to thought leaders, founders who tracked metrics, so tracked their performance, or who listened to customer feedback, all were more likely to perform successfully than startups who didn't do that. So there are a number of methodologies used to value startups. I'm not going to go through those, but one of the most important things is to know that revenue is not necessarily a good determinant for the value of a startup. Lots of investors don't really rely on revenue because most startups, when angel investors are investing at the earliest stages, most startups will have no revenue or very little revenue. So what's more important than revenue is traction with customers or traction with your product market fit and the growth rate. So how are you acquiring users? Is it consistent? Are you increasing from month to month? That's much more important at the earliest stages than traction. One of the main tools that angel investors use to value startups is to consider these 6 criteria, these 6 factors that I've listed here. And try and assess where the startup is in developing these 6 factors. So over a period of time, angel investors become quite knowledgeable in terms of assessing where a startup is on this continuum. There's also, in the last 5 or 6 years, lots of material available to investors and to founders who are trying to determine the value of a startup. So most of these tools that I've listed here are available for free. You can go onto the websites of CB Insights. They publish regular reports on almost every industry. Angel List, you can go onto Angel List and you can compare pricing and valuation for startups in almost any space. So it's way easier now for founders and investors to figure out what the value is of a comparable business by using these tools. So the main point, or the main task of an investor who's investing at the really earliest stages is to assess the risk of the founder not being able to navigate the stages of development before running out of cash. And basically to help the founder manage the cash until they get to product market fit. Because if the founder runs out of cash before product market fit, odds are they're going to fail. It's almost impossible for a founder to raise capital while they're in the valley of death. And so when you're just starting out, you have to make sure that you raise enough capital to get you to product market fit. And that's what an angel investor is trying to assess when they meet with you. And the key consideration in that is that it takes way longer to do that than most people think. The average is 2 years, but for lots of startups it can be 3 and 4 years. The last point I want to make is that angel investors and venture capital investors need returns. They like startups, they like to work with founders, they love to see businesses grow and for regions to become successful because of startups. But at the end of the day, they need to earn a return on their investment. And founders need to consider that as well. So angel investing isn't about getting into an investment, it's about how do you get out of an investment. So the investor mission is to basically find an exit once the company has successfully achieved product market fit and grown its marketplace. And that doesn't necessarily mean an exit for the founder, but it does mean an exit for the investor. There's only 4 possible business outcomes when you start any business. It could fail, in which case the investor loses all their money. It could become a lifestyle business, which could be very attractive for the founder and for the main executives and the employees of the business, but typically won't provide a return to an investor. There can be a merger or acquisition, so the purchase of the business by another, a bigger business, and that provides a return to the investor, or the business can go public. And the message I want to leave you with here is that in North America, 98% of exits for angel investors and venture capital investors are mergers and acquisitions. Only 1 to 2% of exits are actually IPOs. So while we all have heard about the big deals like Microsoft and Facebook and lots of others, the reality is most investor returns come from selling the business to a larger business. And most of those transactions take place at a price between 20 million and 40 million when the company has less than 5 employees. So for founders in the room, that's probably really shocking information. To know that most of the exits that take place in North America are sales to bigger businesses between a price of 20 to 40 million at a stage when the startup has less than 5 employees. And in fact, Google, which is one of the biggest acquirers of companies, their sweet spot is a company that's pre-revenue, has no revenue, less than 5 employees, and they pay less than $20 million. And they are one of the largest acquirers of startup businesses. So knowing that information really might impact how you decide to grow the business. And it certainly impacts how angel investors assess the likelihood of their being able to obtain a successful exit and earn the kind of return that they need to earn. So I'm going to stop there. Thank you very much. It's been a pleasure to be here, and I'm around the rest of the day, so I'd be happy to answer any questions or talk to any of you.